Oppenheimer has one of the highest targets on the street for the S&P. Their year-end S&P target for 2024 is 5,200. We want to bring in John Stoltzfus, the man behind that call, Oppenheimer Asset Management Chief Investment Strategist. John, it's great to see you. So let's talk about the bullish outlook that you have for 2024. Why are you confident, or what makes you, I guess, so optimistic at this point that some of this momentum is going to carry into the new year?
Well, first of all, thanks for having me on the show, Sean. We're positive on this because we really feel that what we saw this year has been the reestablishment of fundamentals that justified the market moving higher, going back to levels that haven't been seen now since prior to the sell-off that we saw last year. And at this point, fundamentals likely to continue into next year, remaining positive as the Fed remains vigilant against inflation, but also remains, as it has been this whole Fed funds hike cycle, except for when it raised rates at 75 bips 4 times in a row. Essentially, what you have here is a Fed that has been very sensitive as to how its mandate affects the economy. So we think that's what really carries this. It's not a robust economy, but a resilient economy, evidenced by business and the consumer, with jobs still remaining plentiful, even as that jobs number has come down, and the likelihood that this will bode very well for revenues and earnings, not only for the S&P 500, but likely for other major indices, including mid caps and even small caps.
And so, John, you were kind of giving us some indication of how much this call that you've made also relies on the Fed. How many cuts, though, does it also rely on from the Fed potentially?
Actually, Brad, much fewer calls than the traders will tell you are coming up. We think next year the Fed likely remains on a long pause or a long skip, as it has been this year, with the likelihood that in the second half of the year is when we'll see the cuts, and in that second half, maybe 1 or 2 cuts. The biggest problem being that, with higher wages, people continue to spend, and the ability to remove all that stickiness and inflation might be tougher to find, but nothing overly negative, we think, for equities in terms of Federal Reserve action.
John, you mentioned their earnings just a moment ago. When it comes to some of those positive trends that we have seen over the last quarter or two up until this point, what do you think earnings growth looks like as you look ahead to 2024?
Yeah, we were looking for, we readjusted our earnings target down from 230 to 220 for 2023. So we think probably about 9-10% upside in earnings growth next year to around 240. And we think that really occurs as companies remain remarkably adept at navigating an environment with advanced technology, whether it's to curb costs, to improve logistics, manage logistics or manufacturing processes. And we think that the earnings will take us, that makes our multiple on that 5,200 target about 21.7 times where we stand now on a forward basis, but likely more attractive, a little bit less than that by year end next year.